Well, thank you so much, Carolyn. I appreciate the introduction. As Carolyn mentioned, my name is Brent Hoover. I work here for the Aiken area SBDC. I'm also a professor here at the School of Business at USC Aiken as well, considering we are housed on the university additionally. So for today's topic, I appreciate you joining us for cash flow and credit. So I can give you an overview of what we will be discussing. As Carolyn mentioned, if you have questions throughout this webinar, please put them in the chat box. I prefer you go ahead and do that. And that way you don't forget about a question at the very end and you're like, shoot, what was I going to ask? This way we'll be able to get all the questions answered at the end of today's webinar. So let's go through the agenda, shall we? So of course, this is an SBDC event, therefore we have to educate everybody on what South Carolina SBDC can offer you or your business. Then of course, we'll cover into the cash flow analysis, hence why that is the first half of today's webinar. And then we will have a brief overview based on Matt Breeden with First Citizens, and he will talk about the credit analysis. And finally, we will also review, and that is where we will answer said questions. So let's go ahead and get started, shall we? So what is the SBDC? One person joked here a few years back at one of our statewide meetings that we're one of the best kept secrets of South Carolina. And you know what? That's probably in a way true. So we stand, of course, for the South Carolina Small Business Development Center. So in essence, what we do is help businesses either get started or they grow. So even if you're just thinking about doing a business, you've been operational for maybe 2 months. Heck, you've been operational for 20 years. As long as you fall under the SBA size table for a small business, we can assist. There's no charge. And of course, everybody's always like, well, what's the catch? The catch here is we do need to track metrics because we're funded by all levels of government, federal, state, and here in Aiken, even locally. Because of that reason, we have to track metrics such as the number of businesses started, the number of clients we've assisted, the number of loans we've helped with. We aggregate those, never release them individually, and that is how we stay funded as a no-cost service. And as such, there is no charge to a business such as yourself. Now, we also, of course, provide the confidential counseling. That's one-on-one. We are all bound by confidentiality under SBA. We have to sign that each and every year to ensure that that information that you give us is protected. So unfortunately, we can't help with tax or legal advice because we're not tax professionals and we are not attorneys. However, we can connect you with said professionals. And that gets into the second point, the access to the valuable resources. So part of that, we have a resource guide, say for the Aiken office, but more importantly, we are located throughout the entire state so we can get you connected with the appropriate area. As long as you're a for-profit business and you are going to do business here in South Carolina, we can assist with those manners. The third point, as you might imagine, we're here today for the training and education. So we've been doing these webinars for quite a bit of time. COVID actually helped start this trend of the Zoom webinar. It's worked out very well. And as such, we've continued the cash flow and credit. Now, if you'd like to be apprised of what we are going to offer, you can stay up to date either through our email list or you can check out our website that has a particular portion for just events. You can see the current events, you can see the upcoming events, and you can even see past recordings, okay? And last but not least, we also have an initiative in regards to cybersecurity. SBDC has a tech committee team. I'm actually on said committee, and we are about helping our clients look at models such as the CMMC or the Cyber Maturity Model Certification, the very basics of cyber hygiene. No, we're not cyber experts, but we can help people understand and prevent them from being soft targets when it comes to digital attacks. Now, this is just a small section of what we can offer, right? But of course, we wanted to articulate to you what we could help with your business as you progress. Now, that said, let's actually get around to the topic at hand, the cash flow and the credit. So with the cash flow portion, I would argue that's probably one of our best offerings to the public here in the Aiken office. Why? I have a focus on cash flow and Excel modeling. Now, in that regards, I'm trying to approach this from several facets. I know some of you are from different stages. Some of you just considering doing a business. Some of you need a loan package. Some of you just want a better understanding of your current financial performance. I'm going to try to hit all facets of those. Therefore, there's something applicable to each and every attendee. The number one thing I like to always stress out is the assets are not always necessarily the same as cash flow. The assets equals liabilities plus equity. That's the accounting equation 101. If you suddenly groan about said equation, guess what? It's going to come into play, particularly when we look at benchmarking your business from a cash flow performance. But cash is only making up a facet of your overall assets. Just because you have, say, a building that may be worth $2 million, but you literally have $2 in actual bank account. Granted, that's a very contrasting example, but hypothetically, it is showing there's a difference between having assets or net worth and actually having liquidity. Why is liquidity so important? Because we want to be able to pay our bills on time. We want to be able to grow, pay ourselves, of course, along the way. So hence why it's so important. But I always like to preface my discussion on cash flow with this statement. Now, if you see the second one, the end is the beginning. The end is the beginning. It's kind of a play on an old song for that matter. But I like to look at this from reading right to left. Because when we're doing cash flow modeling, I need to know where we need to end up. Some people come to me and they're like, hey, I need to know where my business is going to be in 2 years. Well, part of that's going to be looking at your expenses. But more importantly, how much are you going to pay yourself? What do you need that to be? Because a lot of the tools we use with data analysis, such as GoalSeek, is all reliant on knowing the end result. It doesn't mean you have to necessarily get to said end result. You may fly short of it. You may fly above it. But it is still looking at this with the objective in sight, and then we're able to see how do we make said objective achievable. And one of those best tools we end up regarding liquidity is actually turning to the balance sheet immediately. I know you hear balance sheet, once again, you might groan on that. It's showing your assets, your liabilities, your equity, and you're like, okay, that's there, but what does it really mean? We really want to tie in and see what are the 3 best liquidity financial ratios. One of my former peers used to say financial ratios were essentially a thermometer for how well your business is doing. The 3 on the bottom here are the current, the quick, and the cash ratios. Depending on your business model, they may actually be all the same from a calculation. Some may differ. In essence, what they're focusing on are really 2 key categories: your current assets and your current liabilities. In essence, those things that are less than 1 year. All right. So in that case, anything that's already cash or cash equivalent is going to fall into that, but also too accounts receivable, your inventory, any other current assets that would be applicable as well. Current liabilities, those debts that you are required to pay off, but they're not looking at, say, a 20-year loan for that matter. They're looking at the short term, perhaps accounts payable. You actually have to pay your vendors. With the current ratio, it's literally just the current assets divided by the current liabilities, and it will give you a number. And this is one thing I suggest actually putting down in your notes as you're going through this webinar. Whatever calculation you do here, whether it's current, quick, or cash, divide it back into 1, because it will actually help you better understand what's going on here. Like with the current ratio, I said it's current assets divided by current liabilities. Let's say you have $2 in current assets, you have $1 in current liabilities. So in essence, your ratio is 2. But if you put it back in the fractional form of 2 divided by 1, you can actually see what it's meaning. For every $1 in current liabilities, you have $2 in current assets. Okay. It's essentially seeing how well you can cover those short-term debts. The only difference with the quick ratio, in essence, is it's just taking out inventory of your current assets. Now, if you don't even sell inventory to begin with, there's going to be no deviation most likely between here. Okay. But if you do sell inventory, you may know liquidating said inventory is not always the easiest thing in the world. Therefore, you need to subtract out of it, because essentially it's saying, once again, how quickly can we liquidate if need be? So once again, if you have inventory, this is going to be a smaller ratio, but it's basically using the same logic. For every $1 in current liabilities, what do we have in current assets excluding inventory? Now with the final ratio, it's one of my favorites because it's just the cash. In that case, it's literally basically looking at cash plus cash equivalent. Technically, I think they throw market securities in there and divide it by current liabilities. But for pretty much every one of you in small business, it may just be the cash divided by your current liabilities, which just may be your credit card debt, accounts payable, etc. I really like these 3 ratios because once again, I'm able to see what's going on with your liquidity coverage. When you get a bank loan, you have to have debt coverage or debt service coverage. In this case, it's really looking at your short-term debt coverage for that matter. So I always go into our conversation on cash flow with these 3 ratios. Why? Because I think they're so paramount to moving forward. Now, what are some good or best practices, I guess we should say, based on cash flow? Number one, ideally speaking, can we get a working capital buffer of 6 months? So you're like, well, how do we figure out that working capital buffer? One of the best ways you can do this, you can look to see what are all your operational expenses on a monthly analysis. Maybe it's say $1,000, right? Given that you might be a smaller size business, working from home, low overhead, you don't need much. Or that could be $10,000. Whatever said number is, you start to multiply it. And in this case, you would multiply it by 6 to get a good sense of what's going on with a buffer needed. So if it's $1,000, an ideal scenario might be here $6,000. Why? Because you're looking at a scenario that is less than ideal, and you want to be able to cover any unexpected expenses. Now, some businesses may say that's not even feasible to have a 6-month buffer. All right. Can you get to 3 months? At the bare minimum, can you at least cover 1 month into the future, assuming your gross revenue generation does not go the way that you intend? But it's one of those where I'm always encouraging businesses to look at that, because on the prior slide, we saw the current, the quick, and the cash ratio. I've seen some numbers where those ratios may look not too bad, but then I actually look at the working capital buffer, which is looking at a dollar amount, and it's not as encouraging. Therefore, once again, things all require context. It's understanding cash flow is just not one simple facet of your business. Like you see a ratio, you're like, okay, that's the end all be all. No, it's not. It requires context and understand what's going on with the connectivity of your business, but also to how that relates to the industry as a whole. Now, granted, this has a credit component of the webinar moving forward. And as such, you know that it was going to come up about the FICO score. What's going on with the personal credit? Now, I will leave that primary discussion to Matt, given that's what he is focusing on. However, it's a good prerequisite for us to discuss about, and that is the 680 plus. Why? Because in the case of SBA loans, most subset loans want this as a minimum amount. Therefore, it's good to discuss here. Now, understand personal credit and business credit do play a factor together in the discussion. You may or may not have heard of the PAYDEX score. PAYDEX score is just one of the available business credit scores. In those cases, it's very academic. It's a scale of 0 to 100. You want to be most likely 80 or above because it means you pay your bills on time. People are like, well, I don't need to get a loan. Well, just because you don't need to have a loan right now doesn't mean that you're not going to have to get one in the future. Therefore, why not keep a good track of your credit scores, both personal and or business? So once again, it may not be so much a cash flow analysis. It could impact on what you have to get for a loan in regards to interest rates, which of course will affect the amount of interest that you have to pay and thus indirectly impact all these ratios that we talk about. And last but not least, what are you planning to do with collateral? Now, in those cases, it could just be cash and it's 100%, it's already liquid. Could be things that are discounted, such as building, land, etc. While you may say those aren't truly cash, guess what? You're still seeing how quickly you can liquidate them into cash for that manner. And if you had to go to a bank loan, it's always a good idea to understand what's going on with potential collateral, essentially a schedule of assets that could be used to secure a loan. But once again, I really stress going back to the working capital buffer because that directly ties in what's going on with your cash flow in this regard. Now, the process slide here is really going to be dependent on what you're doing with your company. Some of you are needing financing and therefore cash flow is of paramount importance because the bank needs it. Well, that's great. Some of you are like, I don't need a loan at the moment. I just want to understand what's going on with my company. Some of you are just in pre-venture stage and are having to forecast simply for your own purpose. In those regards, it's great to start to put together the two things involved, the P&L and the balance sheet. P&L, also known as the income statement, profit and loss, hence the acronym defined here. In that case, you will see your gross revenue minus your expenses. You'll end up with a net profit. And of course, you pay out things such as taxes, paying yourself, etc. And essentially, you have a profit margin or your net cash that is left over after everything is said and done. I mentioned the balance sheet. It's the assets equals the liabilities plus equity. It's got all three components in there. And we're able to see maybe what's in this checking account, how much we owe our vendors, how much our customers owe us, and of course, what's going on with the contribution of equity of the members of this company. If you're going for a bank loan, you're going to need to prepare these in a timely manner. Now, in that case, you're saying, I don't need a bank loan. So what? These are still crucial documents for you to consider moving forward. Now, the reason I talked about the business plan here, no, this is not a discussion on business planning, but I will stress that if you were ever to write a business plan, guess what? The plan is really revolving around these numbers. So it could be a business plan about you looking for an expansion with a new project, or it could simply be your internal business plan. Guess what? A lot of that's still revolving around these numbers. And hence why they're in bold and at the first part. And last but not least, once again, right? If you need to get a loan, you're going to need these documents. And they all start in order and fall back on the root of the P&L and the balance sheet. So in this case, once again, I'm just stressing the context, how everything is connected together, and hence why the numbers are the root. Now, please also understand as you are looking at your numbers, unless they are actuals, and even if they are, they're actuals coming out of, say, your QuickBooks account, make sure the information is reliable. In data analysis, we talk about validity versus reliability. A lot of things are valid, meaning the formulas actually function as intended. Like if you divide whatever's in current assets divided by current liabilities, you'll end up with a current ratio. That doesn't say necessarily if the information that you inputted is reliable. Meaning, have you kept your QuickBooks up to date? Did you get an accurate quote from, say, a vendor when you're building your pro forma? Those things have to be considered in order to ensure the accuracy of said information. But once again, understanding the connected nature of all of this. All right, so if we are going to get into analyzing the cash flow, I often say there's a golden rule when dealing with either pro formas, meaning forecasts, say for a bank loan, etc. You overestimate the cost, you underestimate the sales. Now, if we're actually analyzing our current performance, right, those are the actual numbers, hence why the name suggests it. But if we're using that to see where we should be in the future, I always like to consider this scenario. Why? Because it paints a less than pretty picture. Most times, if we were analyzing our cash flow for a bank loan, the banks are really only caring about one thing. Are you going to pay them back on time each month? In that scenario, you may say, well, sales can be $10,000, or you look at your QBO actuals and you're like, hey, we're doing amazing for the monthly sales. That's what you're doing right now. It doesn't mean this is always going to ring true into the future. So therefore, you need to be prepared for those scenarios where it does not occur in the best manner. And because if you're overestimating the cost, you underestimate the sales, I say nothing's going to come back to probably bite you in that scenario. Why? Because in those scenarios, you show that you are still liquid. And there's a couple of good ratios we can figure out to see if that's the case. I mean, obviously you hear about profit margin, but then there's another one I like to calculate. It's the owner's coverage ratio, where essentially you treat yourself as the bank, and we're going to talk about that moving forward as well. But once again, cannot stress that's important enough. On to the second point, the forecasting the sales versus the expenses first. I kind of see this if people are building out pro formas, either to see where they want to move forward and grow from a strategic standpoint or just from the bank loans perspective. I'm more on the line of the expense first element. The thing is with forecasting sales, Excel is a great tool to actually be able to do that. There is some manual adjustment that needs to be done. Like if you actually have all your monthly sales, right, out of QuickBooks, maybe you got out of Square, etc. You can bring them into Excel and forecast at 95 to 99.9% confidence in it. Now, Excel will usually detect things automatically. Sometimes you have to tell it to detect manual seasonality or shifting points. That actually requires real data. Let's say you're at a pre-venture. You don't have access to said data. In that case, you're going to be starting with the expenses first. I really like to do that because I know that you're going to have to pay bills. You got to keep the lights on. You got to actually, let's say you're leasing a place. You got to pay the landlord, etc. You know those figures are going to happen. And then what you can do is you can calculate all the expenses first, include yourself in there, include the bank if need be. That's a debt repayment. Compensation to officers would be you. And in that case, then you can actually model and see based on that, where do we need the sales to be? It goes back to my prior point. The end is the beginning, working right to left. With that said, I have a third point on the slide in bold, and that gets to what we know as benchmark. You'll hear it be called common size, industry multiples. the terms are interchangeable for that matter. But for here, we're looking at our benchmarking ourselves because we have access into different softwares such as ProfitSense, IBIS World, Vertical IQ, etc. For those cases, we can pull the data on what a healthy company should be doing in your industry. When I was starting out in my career, I actually didn't put enough of a focus on this, in my personal opinion. I was so focused on the dollar value. And that's, once again, not to be underestimated. I mean, you look at your bank account, it's in dollar values. But the relation of the dollars is just as important. And so with the P&L, the income statement, right? You got your revenue, you got your expenses, net profit, very basic. Everything is sized up as a percentage of sales, including sales itself. You times that by 100 and you can see like sales, a percentage of sales is 100%, right? It's divided into itself. But how much is advertising as a percentage of sales? How much is your net margin in that case? I mean, that's the whole idea behind, the profit margin is taking your net income divided by the sales. What about cost of goods sold? What about your utilities? Any and all of these can be calculated as a percentage of sales. And you can start to see where you should be in that relationship. Now, for the balance sheet, you actually have to do this a little differently. Instead of percentage of sales, it's a percentage of total assets. So clearly, your liabilities and your equities combined together, according to the identity equation, A equals L plus E, assets equals liabilities plus equity. It's got to come out to be 100%. But how much of your liabilities make up your total assets? How much does just the cash that you have encompass of your total assets? Now you're going to end up with a number. And people are like, oh crap, what does this number mean? A statistic is only as good as the context. And therefore, that's why we look at what's known as industry multiples or common size. We'll pull the data on a NAICS code, an industry classification code. And therefore, we'll see all of the percentages for a healthy company within that industry. And we can see how your ratio or percentage sizes up to the industry average. Now, just because you're over or under, once again, doesn't mean the world is falling. But if you're asking, how do we improve the cash flow situation? This is one way to do it. So whether it's the P&L or the balance sheet, these are things we still must consider nonetheless. Now, this does tie into some other elements, of course, as well, like for the pro forma creation, I mentioned the working capital buffer, but there's two other ratios I'd tell you to pay attention to as you are analyzing your cash flow. Number one, debt service coverage ratio. Number two, owner's coverage ratio. The debt service coverage ratio takes your net income and divides it by what you have to pay back to the bank. So in essence, whatever that number is, net income divided by payment to the bank, that gives you a statistic. Subtract one out of it, and it tells you how many future payments you can make to the bank without tapping into your savings. So if you have any kind of debt, you can actually see where you stand in terms of the coverage ratio. Ideally, banks would like you to be 1.25 or above. Some are willing to go even lower, like 1.1. But you could even look at it from the fact of what's going on with debt even outside of the bank. The same philosophy can still apply. And it also applies to the owner's coverage ratio as well. I don't know if this is technically a formal term for it, but it's the close enough that I've started including it in my own cash flow analysis. It treats you as the bank. Because if you can't pay yourself, why are you in business to begin with? And instead of net income divided by debt repayment, it's net income divided by the payment that you make to you. And so one of those things is we use a simple tool like GoalSeek in Excel, and I say, all right, we're going to set the owner's coverage ratio to 2. 2 is really healthy because it's a 1-to-1 match. It essentially says your business checking account is growing at the same as your personal bank account. If you're in said scenario, you're going to be all right from a cash flow standpoint. You're moving along on a healthy relationship. But sometimes you don't have that luxury, and that's okay. But these are just ratios to pay attention to as you move forward. Now, for those that are working in existing cash flow, one of the best ways to figure out how to analyze anything, you got QuickBooks, go into the reports, load up the P&L. You can do P&L monthly. You can do P&L detail. It just once depends how granular you want to get. Export it to Excel format. Bring it into Excel and you can play around with it. Now, the new versions, updates of QuickBooks Online, I don't know how much you've been paying attention to, allow you to actually start modeling within Excel. They got the spreadsheet sync that's been debuted with the new tool. Really cool thing to work with as well. But some of you may say, well, look, I want to get more into solver, and you will just export. Either way, it's perfectly fine, right? But it's a simple tool that will literally take you less than 60 seconds and be able to actually manipulate what's going on in what if scenarios. All right. I mentioned profit center earlier. That's where we pull a lot of our data, and I'm actually able to compare that. We can input tax returns into the program. It does not allow us to put any personally identifiable information in there. You have to use a generated number, so it protects identities, but it's able to actually see what's going on with the data at hand too. You can actually get a sense of where the forecast may go. It's going to give you all the ratios, compare them to the industry averages, etc. One of those things I really like to stress out, and I don't want to spend too much more time on the slide, but it's this: the MB is greater than or equal to MC. Anytime you are going to bring on a new expense, marginal benefit has to be greater than marginal cost, ideally speaking. So if you want to actually say incur a new expense of advertising, is that advertising returning revenue? Are you getting return on your investment for that? In those cases, we always look to see, well, what are the analytics showing for that scenario? And because of it, I actually realize it can be applied to nearly any facet of your own company as you analyze your cash flow. So whatever it is, whether it's new employee, new advertising route, is it earning its bang for the buck? It's not, you may need to reconsider said strategy or tactic in that manner. And last but not least, the aging accounts receivable and aging accounts payable. How you stretch out your cash flow, depending on how you run said business. But you can see within industry averages, how often before you collect on accounts receivable, how many days before you actually pay with accounts payable, okay? Pay attention to that. And of course, if it's accounts receivable, you see something's past 90 days. Yeah, in that case, it's probably going to end up as a bad debt expense in that scenario. But who knows, you may actually see your money out of it. It's one of those things we can analyze further in QuickBooks Online or a different program of your choice. But this is a good slide nonetheless to see what are some simple things that you can take advantage of with your actuals, particularly relating in to QuickBooks. Okay. Now, if you end up occurring with cash flow problems, before COVID, I had read one poll. I can't quote the source of said poll, but I think it was about 59% of businesses experienced some form of cash flow disruption. And as such, one of the things we look at is, all right, let's turn to the benchmarking, because the benchmarking is going to be able to say, where are we out of alignment with the industry averages? And hopefully we can identify within there the discretionary costs. Discretionary costs are things non-essential, and they don't necessarily earn any bang for the buck. People might say, hey, well, advertising is discretionary. Hold off on that. Is the advertising actually earning additional revenue or marginal benefit? If so, it's not discretionary. But it could be the fact that you can't afford to go to a conference this year, or you can't afford to get the best maintenance on your piece of equipment. You know, those might be discretionary as well. Some people end up going to buy a used route. Once again, you kind of have to figure out what you're getting. Why is it so cheaper? You may have gotten yourself a good deal. You may have actually asked to be nickel and dime on maintenance into the future. And as I mentioned, everything's mostly set up as a percentage, right? Well, the performance center within QuickBooks will actually allow you to track that. You can analyze everything as a percentage if you so choose. The one thing I would suggest, though, that you do not make a percentage is the owner's payment. Because the owner's payment is really tied into what you need to pay your bills, grow a savings account, etc. That's a dollar value. And in essence, I see that as a hard dollar. The rest of them are soft dollars where, you know, you can see maybe that we are spending a little too much. We can pull back on something. There are other things too that you can't control. You know, if you're leasing a space and you're locked into a lease that says you are paying $1,000 per month, once again, you're kind of stuck with it. There's not much you can do on that outside of finding a new place. But don't underestimate the owner's payment, the payment that you're making to yourself. You know, the buck stops with you as a business owner, but as a consultant, I would highly advise that you make that a hard dollar. You know, if you need $50,000 to live, don't rely on a percentage of sales necessarily for that. Now, granted, if you increase sales, you can get it up to that amount. But once again, that's what's necessary for you to probably live in that case or have a healthy financial lifestyle. So some things you do have to consider more on percentage, others on dollar value. And one of my last points before I turn it over to Matt is the food for thought slide. You know, I hear about inventory. I'd mentioned it with the quick ratio. You take that out, when calculating said liquidity ratio. One of those things, there's quite a few inventory statements out there, but one of the best things you can always look at are several formulas to determine what is a good safety stock, because the inventory valuation statement in QuickBooks will tell you what's going on with all the inventory there. But the sub bullet point underneath that is essentially one way of calculating a safety stock level. Because some people are looking at it and they say, oh, my inventory is larger as a percent of sales, far greater than the industry average. Maybe we calculate a standard deviation on it, and it's 2 standard deviations beyond the industry mean. Well, maybe we need to figure out if we were actually overbuying. Sometimes you get paranoid with given supply chain issues and you do overbuy as a safety levels. But this is just one formula if you're ever interested in, you can actually use to calculate it. Is it the end all be all? No. But once again, it is food for thought. And my second bullet point, build supplier relations. If you're worried about not being able to meet a payment in the future, you have healthy relationships with these vendors. Those relationships may actually be used to call in a favor once in a while in a contingency scenario and keep you afloat. And last but not least, speaking of the contingency cash, that goes back to the working capital buffer. Your operational expenses, hey, is this 3 months? Is it 6 months, etc. Once again, I know we're on a limited time here, therefore I want to be respectful of said time. But these are all facets that we could discuss moving forward on cash flow analysis. And if you have any questions, of course, I'm going to put back this slide. You can sign up as a client down the road, but we'll take this slide back once we get to the end. For right now, I want to turn this over to Matt, so he can talk about how credit impacts this as well.
And Matt, before you get started, Brent, there's one question for you.
Yep.
It's what is more important, variable, the net income, or cash flow?
What is more important, the variable net income or the cash?
And there's more to that. Does loans are given based on your cash or your EBIT?
Okay, on that case, we're going to have a lengthy discussion with getting into debt service coverage as well. So I'm going to say, how about we take that at the end for this case? And because Matt's impact is also going to reflect on those questions as well.
Excellent. Thank you, sir.
No problem. Matt,
and welcome, Matt.
Hey, thank you very much. That's a great question. I love these questions. I was a few minutes late. I do apologize. We rely on technology for everything, and when it doesn't work, it creates problems. So I had a little trouble, but I appreciate having the chance to join. Just a quick little introduction. My name is Matt Breeden. I work out of our North Augusta, Knox Avenue, First Citizens location. Pretty much what my role is, aside from running the branch here, is I support most of our local business clients in this area. And so that's really what I do all day, every day, is work with business clients. And so that was some really great information that Brent shared. I want to emphasize 2 things that he said that I wrote down. So number one, first and foremost, if you can't pay yourself, then why are you in business? You've got to be able to not just stay in business, but you got to be able to pay yourself. So I love that. And then something I've noticed is not, it's so easy. Most people who get into business for themselves do so because they're incredibly passionate about whatever it is they want to start a business doing. And so it's so important to let that drive you, but to also give necessary time to look at the things that Brent went over. And, that stuff is so incredibly important because you don't want to just do what you're passionate about. You want it to be a strong business. So a lot of great information. So I'm going to talk a little bit about how business and personal credit really is intertwined. This is something that I've worked a lot with over the years. I've had clients that, there's a lot of misconceptions when it comes to business and personal credit, as in they're separate, and they're really not. So we're going to talk through some of that. So Brent, if you'll switch to there we go. So a lot of this information you probably already know because it's very similar in most ways to your personal credit report. So if you pursued a mortgage or a car loan or anything like that personally, you've dealt with credit. And so I like to think of credit as your track record. So it's your track record of paying back your debts. And so you can have the best business plan in the world. You can have the greatest idea in the world. But if you come to a lender to borrow money, the number one thing they're going to care about is, all right, if we lend this money, are we confident in that we're going to get paid back? And the way they will determine that is through your credit report, which is your history of repaying your debts. No different than personal. It is very important to regularly monitor your business credit. There's three main credit bureaus that are in the U.S. You've probably heard of them: Equifax, TransUnion, and Experian. Just like personal, they may vary. And so what I mean by that is it's important that you take a look at all three of them at least once a year to make sure that they're accurate, because there are times where, and being honest, I don't even know how some things happen, but you may be named Bob Smith and another Bob Smith negative credit item might show up on your credit report. And if you don't know it and don't see it, you can't do anything about it. Every bank usually is going to have its own formula, its own partnerships for how it pulls credit and factors in credit. So I did include on the last bullet point the first citizens model, which is we report out to all credit bureaus whether you pay your bills on time or not. But when we are going and deciding if we're going to be able to approve a loan application for a client, we primarily use Equifax for the personal credit. And then for business, we use a blended score from Experian. So it takes your personal credit as well and blends that with your business credit and comes up with a score. Brent, you can skip to the next one. So this is really what goes into your credit. So I'm going to touch on each of these. There's percentages, so all of these are important, but there are certain things that weight differently than others. So the length of history. So just because you haven't had credit for 2 decades doesn't mean you're not going to be able to borrow any money. What's most important is that however long you have had credit, that you have a good history with it. So new accounts. So one thing that can have a negative impact on your score is constantly opening accounts, closing accounts, opening accounts, closing accounts. Because part of that process is typically the credit inquiries. And so between opening and closing the new accounts and the credit inquiries that go into that process, those can all negatively affect your score. So amount owed. So this is incredibly important when you're talking about credit cards, lines of credit, because it's important. The bank is going to want to see, all right, you've got this available credit. Are you responsibly managing that? And so what that means is typically keeping the amount you owe under 30% of your credit limits. So there may be situations that you have to exceed 30%, but what's most important is that traditionally throughout your credit history that you've maintained as low a balance as you possibly can. If you come to the bank and let's say you've made your payments on time, but yet everything's maxed out, it's not going to be a good thing. It's going to be a negative thing because it's going to look like you are relying too heavily on that open credit. Types of credit. So this is mortgages, student loans, credit cards. It's good to have a good blend of these things. So you don't want all credit cards. You don't want all installment loans. You want to have a good blend. And then number one, first and foremost, is payment history. So making your payments on time, not skipping a payment. The best advice I can give is, we just finished going through a pandemic and there was, more people than you can imagine that were impacted by that. Even though that might be, we might be phasing past that, there's still going to be things that happen in your life, happen in your business that you don't expect. And you may be in a situation where you can't make the full payment like you normally would, or you might not think you can. If you ever find yourself in a situation like that, proactively reach out to your bank, to your lender, whoever you feel is going to be impacted, and let them know up front and try to make sure that there's a plan in place, because if you can work out an agreement before the bad stuff happens, that's the best way, because it limits the impact to your credit report. So good credit, this is your personal scores. We're going to touch on business scores in just a minute, but this gives you kind of different categories. Now, I can't say that, every bank and even within a bank, even at First Citizens, there's not a hard, if your credit score is not this, you're declined, and if it is, then you're approved. Most lenders are going to look at the overall picture. And so, but it is important that you have a good idea of what credit score personally you're going to shoot for. And so it goes without saying, the stronger your personal credit, the better. So anything 680, I think Brent mentioned this earlier, but you absolutely want to have 680, not just at First Citizens or any particular bank, but just in general. That is, if you've got to pick a number, you really want to have it over that. 700 is kind of the top tier when it comes to a lot of business loan approvals, but 680 is the absolute minimum that you want to do whatever you can to get there. So what's your business credit? So you have a business score just like a personal score. It is a little different. Typically, it's going to range from 0 to 100. The higher the score, the better. And so there's a lot of items that go into your business score calculation. It's a little bit different when it comes compared to personal, because most of what goes on your personal credit is going to be your loan payments, your credit cards, things like that. There are additional factors that can go into your business score. It's going to be the traditional things: on-time payments, utilization of your revolving debt, keeping that low. Obviously, any collection items, charge-offs, those are all going to have terrible impact on your score. But other things like length of time in business, and also sometimes what type of industry you're in, can all have an impact on your business score. When you're starting out and you're brand new, you're not going to have typically a business score. You're going to be relying 100% on your personal score if you do approach the bank for a loan. So even more reason to keep that personal score as high as you possibly can. Get to the next one. Yeah. Okay. And these are some of those other things that we mentioned that can affect your business score. So I'm going to start at the bottom, actually. This is one of the ones I mentioned. So the line of business or the industry you're in. Every industry is assigned a code. It can be called an SIC code or sometimes a NAICS code, which basically just is a code that all financial institutions are going to have on file for the type of industry you're in. So if you have a gas station, you're going to have one industry code versus if you have a retail store, you're going to have a different industry code. Depending on what industry code you fall under, it can actually impact your score. The number of trade experiences, balances outstanding, payment habits, trends over time. So again, it's going to look at your entire overall picture and your entire history. So increase in number of business credit inquiries, just like personal credit, it's very important that you not excessively run your business credit. What that does is it gives the appearance that you are, if you come to me and you complete a loan application, I'm going to pull your business credit. And it's going to pull in all the debt that you may have, all that. If there's excessive inquiries, it can cause the bank to wonder, okay, do we have to really worry if this person's going to go out after we extend credit to them? Are they going to then go to another bank and another bank and another bank and overextend themselves? So reasonable inquiries is incredibly important. And then, of course, public records, collections, bankruptcies, all of those kinds of things are going to have an impact. So a question I get asked a lot is how long do things stay on your credit report? So this gives you a little information on several different types of items that are on your credit report and how long they'll typically affect you. So trade data is 3 years. Bankruptcies is going to stay on there a long time, so over 9 years. Judgments and tax liens, I don't know where they come up with the 6 years and 9 months. I'm sure there's some reason, but 6 years and 9 months. Uniform commercial code filings, and so you may know what these are, but these are going to be things. Depending on what type of business you're in, you may have the need to finance a piece of equipment, not necessarily a truck or a vehicle, but a piece of equipment. It could be financing lighting for your office. It could be a whole host of things. And a lot of times the bank will take out a uniform commercial code filing, which is also called a UCC, which is, we call it a soft lien. So it's kind of a way to take as much collateral as you possibly can in exchange to protect yourself when extending credit. So collections, the popular 6 years and 9 months, and then most other things is about 3 years. Personal credit versus business credit, again, it is so incredibly important that everyone understand that personal credit is just as important, if not more important, than the business credit, because you are, even though you may be operating as a corporation or an LLC or a different entity, as the business owner in a for-profit business, you are going to be required by the lender to be what's called a guarantor. And so the guarantor is not necessarily the person that's going to hold the debt, because the business entity is going to hold the debt. But the guarantor is the bank's insurance, I guess you could call it, that debt's going to be paid back. So if the business was to not follow through and pay their debts, it then falls on to the personal guarantor, who would then personally be responsible for it. And that is the reason that they, as well as the business, have to credit qualify. Creditors today are moving away from relying alone on the personal credit of the borrower, but also the business credit. And then sole proprietors, they're basically all in one. So if you're a sole proprietor, that means you are the business. So any debt that you accrue in the business name is essentially in your name, because you're not operating in this instance as a separate entity. Seeing a lot of great questions pop up, so hopefully we'll be able to go back to those. So key takeaways, personal credit and business credit both determine your lending options. Using your personal credit for business use can impact your ability to borrow personally. So for example, if I'm starting a business and I go and I apply for a Capital One credit card in my personal name to buy all the necessary equipment, that is personal debt. So it is under my personal name. So if I then go to want to apply to purchase a car, purchase a home, if that debt is in my name, whether it's paid by the business or not, that will show up. So it can impact your ability to borrow personally. Previous history and the ability to repay are the #1 factor for whether you can borrow money. Under certain circumstances, SBA being one of them, but under most traditional bank lending products, income that will result from doing a loan is not considered. So future revenue under traditional loan products is not considered. It is 100% what have you made and will that pay for it. But again, through SBA and other options, there are exceptions. Strong business credit will not compensate for low credit. So you could have, regardless of your business credit, if your personal credit has significant issues, it can cause a problem. And then just a reminder to consider the same things for your business credit that you do for personal, which is inquiries, revolving debt, and paying your bills on time. So if I had to leave you with one takeaway on this, regardless of the amount of credit a lender may qualify you for, it is your responsibility as the business owner to really have a realistic understanding of what makes sense for you and what makes sense for your situation. If you overextend yourself, it can cause disastrous financial consequences. And so it's so important that if you go to a lender, the lender is going to most likely tell you what you qualify for. But it is in your personal best interest to make sure that whatever that number is, that you feel comfortable with it, because it may be different. Only you know your finances perfectly. A lender is going to look at certain factors, and those factors are designed with the purpose of not just making sure that the person qualifies, but making sure that the bank doesn't put them in a bad financial position. But again, you want to always have your own assessment of whether borrowing X amount of dollars makes sense and is reasonable for your financial situation. So this is just my contact information. So like I mentioned, I'm located in North Augusta, but I'm more than happy whether you bank with First Citizens or not. It really doesn't matter. One of my favorite parts of my job is getting to do things like this, which is just sharing information with anybody. May not know everything, but I try to take what I've learned over the years from working with my clients and share that information to hopefully impact others. So please be more than welcome to take down my number and reach out if I can do anything. But Brent, hopefully we have time for a few questions.
Oh, absolutely. We certainly do. I know we had the initial question I had talked about, saving to the end, and it was regarding, which was more important, the net income or the cash flow, and when it comes to loans, are they given based on the cash or the EBIT? So in regards to that question, one of the ways I break this up is in my Excel template. I have the net income, but then I actually have a final spot on it called net cash. Hopefully that's a positive, it's net cash added. Particularly when I'm looking, just doing internally cash flow analysis, I'm looking at the net cash more so than net income. Because there's several net incomes you can have, like by default on most Excel sheets, net income is just going to be your revenue minus your operational expenses. But in those cases, you still have the taxes that may need to come out of the business, like property taxes. You still have to, of course, remit any sales tax that you collected out of that, but also too, payment to yourself, payment to the bank. And that's why in capital purchases, not to mention things that are depreciable. And because of that, I end up having a final row called net cash added. In my professional opinion, that's more what I mainly pay attention to. Now, in regards to the loan, and of course, Matt can mention on this, one of the best ways just to figure out on that is look at the debt service coverage ratio, because the debt service coverage ratio is that net profit divided by the debt repayment. Because you asked on that question, which one's maybe more important, the cash versus the earnings before interest and taxes. Well, in essence, the DSCR is really going to show this because of the calculation. As long as you are having a healthier net profit, that's going to increase the amount of money that's also staying in the company account that you can pay back the bank, pay yourself, etc. But inadvertently, it's going to go all the way down the line of the cash flow analysis. So the DSCR is really going to show that. Now, in terms of cash, of course, I mentioned the working capital buffer. It's really going to be dependent on the lender. I've had, one lender here say, hey, I want 6 months of working capital for certain industries. That's what they want is the buffer, the thing I mentioned earlier. Some, it gets back into the down payment percentage. That's going into the standard process where it's like, what is your own injection of equity into this bank loan to begin with? Some are down to 10%, some are 15, 20. The SBA, there's a lot of factors that go into the down payment. But in essence, if you're looking at a loan, the DSCR, and keeping that healthy and growing larger, that's going to fix directly, indirectly, really any concerns that are going to come along with the cash. Now, some people calculate that differently. Like some banks have told me, hey, we take the owner's payment or the compensation offers out of that, some included in there. So once again, it's really going to be dependent on the lender. And of course, I really want to have Matt's opinion on that as well.
I think you answered it perfectly. It's not, I can't say one's more important than the other because they're both important. But the bank's going to look at the overall picture, depending on, and things that may be taken out of the calculations for one loan request may not be taken out for another loan request. It really just depends on the specifics. But I don't know that I could tell you one's more important than the other.
Let's see, what are the questions we have here? So David asked, Matt, apparently this is going to be a question for you. When you start a small business, does your personal credit rating help your business credit rating, or is it like starting from scratch?
I guess kind of both. So it does help. So, and again, it can vary from lender to lender, but most are going to use a blended score for your business score. And so that means it's going to pull in your business credit, which if it's a new business, there's likely nothing there, along with your personal credit, and come up with a score. I will just tell you traditionally, as far as what the minimum score is to be approved for whatever you're trying to do, it can vary. But let's say you've got a personal score of 750 and you're starting a new business. Those scores I typically see come in for the business be somewhere between 15 to 20 as far as a business credit score, because that may not sound super high, but it is, depending on what you're wanting to do, often sufficient. So it's like starting from scratch, as in you have no business history. Once you have business history, that's when you'll really see your business score significantly jump. But your personal score is going to be impacting your business rating, and is going to be the biggest factor on what you can be approved for.
Certainly. Matt, I think this is another question for you. It's from Emily. She asked, why are student loans considered in the credit report mix? sometimes parents take on children's debt. Has this ever been considered as not being a part, or is it somehow factored differently?
Yeah, so it's not, I wouldn't say it's factored differently. So the reason that student loans are in there, as far as you are, I'm thinking you're referring to if you co-sign for a child, possibly for their student loans. So the credit bureaus are going to look at that the same as if you co-sign for them for a car loan or anything else. You are, by co-signing, you're likely doing that because them by themselves cannot be approved. So they need someone with either additional income or stronger credit history to guarantee essentially the loan. And because even on student loans, if you've co-signed and your child doesn't make those payments for whatever reason, you are just as responsible for them as they are, which is why it's taken into consideration on your credit report. As far as if they've ever been considered as not being part, I don't know that. They are factored differently depending on whether they are in a repayment phase or if they're deferred. There's different ways. So most banks, if they're deferred, which is usually the case if they are still in school or, depending on their employment, there may be different types of deferrals. They're still going to be factored in somewhat, even though you may not be paying them back. But they're still going to be factored in one way or the other.
Certainly. I believe we had another question. Does it matter what state I establish the LLC in when it comes to financials and tax time? To a degree, I suppose that is correct. I mean, certain states like South Carolina, we don't require an annual renewal of your LLCs. Other states such as Georgia, and I'm not mistaken, North Carolina do for those manners. In terms of, you also looking to see what some of the state statutes are. I mean, like different taxes outside of, say, income taxes, you could have property taxes. Like that's really going to depend on the municipality that you're at. Like with South Carolina here in Aiken County, you may get the tax bill in, say, October, the city in November, you go into, say, Augusta, Georgia, that can vary differently. So yes, to a degree, it is going to make an impact on that. But I mean, one of those things, once again, to stress, if that's a major concern of yours, please coordinate with your CPA on that, and probably, quarterly. I always recommend clients, that we do the cash flow analysis, sure, but also make sure your CPA is looped in on said financial cash flow analysis. It's going to go a long way too. That way everybody's on the same page. Let's see here. I believe we had one last question. What do I need to get a loan? What other alternatives do I have as a small business? Is it a good idea to think of angel investors, grants, and government contracts? Will this help to improve my FICO score? And is it a good idea to acquire a small business at the capital? All right, there's a lot of questions in there. In terms of the loan discussion, we would be probably for a whole different discussion. I mean, the basics they're looking at, is the strength, the idea, and Matt can, of course, comment on this as the bank as well. They're looking at the FICO, they're looking at perhaps your business credit score, cash flow down. I mean, they're going to probably need a pro forma cash flow analysis 2 years in the future. They're going to need a business plan as well. But I mean, a lot of that is going to be dependent on too, what type of loans you're looking for and what the institution is needing. In terms of the angel investors, grants, and government contracts, grants we see a lot of questions about. It's probably the most famous question. I mean, realistically, some of those grants can be few and far between. They can be quite competitive. Do you fully qualify? What are the stipulations? We do assist with government contracting, and we have specialists in-house with SBDC to assist with those cases. And in regards to angel investors, once again, that can open up to a different discussion because it's going into equity base, most likely versus debt. Are you even set up for the right legal structure? In that case, one example could be, are you a C corporation for those manners? So those, of course, do factor in, and it can be a lengthy discussion. Once again, if you're ever concerned about a individual scenario, please reach out because we can meet with you individually and have a lengthy discussion on that, because there's quite a few questions that can follow in there as well. And is it a good idea to acquire small business if I have the capital? In terms of financing, it's really going to be
When's
based
the deadline to renew?
think that you can handle versus other individuals for that manner.
Yeah, if they
I mean,
don't have.
Matt, what are some of your opinions on
where
that
you can
question?
say
From
invoice me.
you as the lender, because I mean, ultimately, I'm the lead agent between the bank and yourself.
But I'll need the receipt.
Oh,
And a snapshot of your
Carolyn, can you mute yourself?
on your credit card to submit with the reimbursement.
Carolyn, you're on. Can you mute
Don't know
yourself?
why you get the snapshot. I'll have to wait until.
I actually don't have the
Well,
capability.
but can you look at your credit card statement online?
Yes, I
Carolyn.
can,
Well, then all you have to
but
do
I'll
is,
have to wait till statement.
well, you can't look at live things.
Maybe.
All right, so the first thing I'll say to that, to the first couple of parts of that question is, it's never a good idea to get any debt for the purpose of building your credit. It's that you don't want to do that. But what you can do is balance, okay, the need to establish business credit with appropriate use of credit. And so what I mean by that, if I'm meeting with, most of the time, if I'm meeting with a client that's starting a small business, and credit is always part of that conversation. Probably the most common thing I recommend doing, and this is for not only business credit reasons, but also protection against fraud, is to establish a business credit card. So that is something that you're going to use to pay for expenses. You're going to pay it off each month, hopefully. So you're going to use it as a tool, but at the same time, you're going to be establishing business credit. But again, I would never get a small business loan or pursue a small business loan just for the purpose of establishing credit. And the second, is it a good idea to acquire small businesses if I have the capital? So again, I don't know that answer would be directly tied to credit. I think it would be more about, how much it was going to cost you to acquire the business and how strong the business was. That is becoming a more and more common thing these days. Businesses acquiring other businesses. And one thing I have seen several times is, perhaps my client's in the same industry as this, and this is essentially a competitor that they want to purchase. Their initial reaction is usually, okay, well, I'm just bringing on those additional customers. I just need to buy this business. Well, you need to look at the strengths of that business. So if you're going to look at acquiring any kind of a business, the best thing I can suggest is look into the financials, make that business owner provide all of that to you so you can see in the books, you can see everything about it. Because one of two things is going to happen. Number one, they're going to tell you no, that they're not going to give you all that. And if that's the case, then that's the sign that you need to walk away. But the other reason is because what you see when you look through the books and look through the financials, that's going to be, it should be a huge part of how you come upon an agreed sales price. Because it shouldn't just be a dollar amount that they pull out of thin air. There should be some thought that goes into it. So.
Certainly. Now, it looks like the last question we had is how easy or how hard is it to get funded from scratch? Well, that's once again going to be a bit of a lengthy discussion, but the short answer is really going to be dependent on what you're doing and the strength not only of who you are, but the business proposal. I mean, so many facets go into that. What's going on with the growth rate 5 years for the industry? What's going on with the competitive matrix analysis? Once again, what's your credit score? How much cash can you inject into the equity? Do you have contingent letters of commitment? I mean, as Matt was talking about, purchasing a business, yes, that's becoming more common because people, all they have to do is build the pro forma. They take the actuals right out of QuickBooks. They adjust what they see fit. They add on the growth rate according to empirical research, and they basically have the pro forma built. You don't always have that luxury if you are essentially a true pre-venture. I would help you say this too. You can get an industry-specific mentor, someone who doesn't see you as a threat, willing to help you out and has knowledge on the industry. That's going to help you once build all the documents too, but you can show the bank this person is, involved with you, just not directly. And not to mention too, I mean, going back to those contingent letters of commitment, now understand those, that's not the same as collateral. That's not the same as you not being able to put up cash to begin with, but it does help strengthen. I mean, a lot of these things, it's going to be between you and the bank for that matter. I can't say that, everyone wants to always say bank loans are easy. I mean, from my experience of helping out on that case, I don't tend to go with that route, but if you go in prepared, you show the full justifications in every facet from strategy and tactics, you are a healthy borrower. It's going to put you in the best place possible. Let's see. Any other questions? It looks like that's it. So Matt, any final thoughts you want to impart?
No, I appreciate everybody's time. Again, if you think of any other questions specific to credit or business lending or anything, please feel free to take down my number. Feel free to reach out. I'm happy to spend a little time with you and, you know, help any way I can.
And as we had on my questions comment too, if you want, anytime you'd like to sign up as a client, you can do so using the link down here in the bottom, the eastcenterdirect.com/signup, and we can get you in. So I appreciate everybody attending. Also too, we're going to be most likely sending out a survey about asking for evaluations on this webinar. So please fill out said survey and I will provide a copy to Carolyn of today's presentation. Thank you so much for joining, Matt. Thank you so much for your time. Your information was extremely insightful and we appreciate it certainly as well. This concludes today's webinar and I hope everybody has a great day.